welcome to the channel. In today's video, we're diving into the current trends shaping the US stock market and what's driving the market right now. We're talking real deals, folks, the kind of stuff that separates the winners from the also-rans in this crazy game we call investing. Whether you're a seasoned investor or just starting out, understanding these key factors can help you make better informed investment decisions. Remember, knowledge is power, and in the stock market, knowledge translates into profits. First and foremost, let's talk about inflation and interest rates, two of the biggest drivers of the stock market today. They're like heavyweight contenders in the ring, slugging it out, and believe me, the market feels every punch. The Federal Reserve, those inflation-fighting warriors, have been raising interest rates over the past year, trying to tame this inflationary beast. And let me tell you, it's about time. When inflation rises, it's like a thief in the night, robbing you of your hard-earned purchasing power, making everything from groceries to gas pump a punch to the gut. To counter this, the Fed steps in with its secret weapon interest rate hikes. They raise those rates, which can cool down the economy, sometimes a little too much, and make borrowing money more expensive than a night out in Vegas. Now, here's where it gets interesting for us stock jockeys. Higher interest rates usually mean lower stock prices, especially for those high-flying growth stocks. It's like someone clipped their wings. Companies that love to borrow money for expansion, like those tech darlings, are particularly vulnerable. They're addicted to cheap money, and when the well runs dry, they feel the pain. But hey, it's not all doom and gloom. Savvy investors are shifting gears, moving away from growth and towards more value-oriented stocks. Think energy and consumer staples, the kinds of companies that are as reliable as a sunrise. They tend to perform better in high-inflation environments because, let's face it, people still need to heat their homes and put food on the table, even when prices are going through the roof. Speaking of tech, despite the pressure from rising interest rates, there's a new sheriff in town, and it's called artificial intelligence. That's right, AI is shaping the future of the market, and investors are scrambling like prospectors during a gold rush. Companies like Nvidia, Microsoft, and Alphabet, the big kahuna itself, Google's parent company, are leading the charge. Nvidia, with its finger on the pulse of the AI chip market, has seen its stock soar higher than a rocket. It's like they've got the golden ticket and everyone wants a piece of the action. Many analysts, and you know I listen to the best, believe AI is the next big thing, the kind of game changer that will transform industries just like the internet and smartphones did before it. This is what gets investors excited, folks. They smell opportunity, and right now that opportunity is spelled AI. But hold on a second. Before you go all in on tech, remember those pesky interest rates. They're still a factor, especially for high-growth companies that are burning through cash faster than a casino owner in Monte Carlo. Now let's talk about earnings reports, the quarterly report card for the stock market. This is where the rubber meets the road, folks. When companies release their earnings, it's showtime. Investors get a peek behind the curtain to see which businesses are firing on all cylinders and which ones are running on fumes. Take those tech titans, Apple and Microsoft. They're like the star quarterbacks of the market, consistently delivering strong earnings even when consumer spending is slowing down. They're the real deal, the kind of companies you want in your portfolio, but not every sector is as lucky. Retail and hospitality, for example, are facing some tough challenges. Inflation is eating into their profits, and higher operating costs are making it harder to turn a buck. It's a dogfight out there, and not everyone is going to come out on top. Earnings season is always a nail-biter, folks. It's like watching a financial thriller unfold in real time. Positive earnings can send stocks soaring, while disappointing numbers can trigger a sell-off that would make even the bravest investor sweat. Chapter 4, Geopolitical Risks, Navigating the Global Minefield. All right, folks, buckle up because things are about to get bumpy. We're talking about geopolitical risks, the wild cards that can turn the market upside down faster than you can say black swan event. First up, we've got the ongoing conflict between Russia and Ukraine, a real tragedy that's having ripple effects across the globe. It's like a stone thrown in a pond, and the waves are being felt everywhere, especially in the energy markets. Europe, with its dependence on Russian gas, is facing an energy crisis. Supply shortages and sky-high energy costs are impacting businesses and consumers alike. And you can bet your bottom dollar that these problems are spilling over into global markets, creating uncertainty and volatility. But wait, there's more. Tensions between the US and China, particularly in trade and technology, are another source of anxiety for investors. These two economic powerhouses are locked in a delicate dance, and any misstep could have serious consequences for the global economy. And let's not forget about those pesky supply chains, which are still struggling to recover from the pandemic. Any disruption in the flow of goods and services can throw a wrench into the gears of commerce, impacting company revenues and sending shockwaves through the market. Chapter 5. Sector performance, energy and consumer staples shine bright. Now let's take a break from all that doom and gloom and talk about some bright spots in the market. Despite all the challenges, there are still sectors that are thriving, and I'm here to tell you where to find them. First up, we've got energy, the comeback kid of the year. With oil and gas prices soaring higher than a kite in a hurricane, energy companies are raking in the dough. It's like they've struck black gold and investors are clamoring to get a piece of the action. But energy isn't the only game in town. Consumer staples, those companies that sell the everyday essentials we can't live without, are also doing a booming business. Think about it, folks. Even when times are tough, people still need to buy food, toothpaste and toilet paper. These companies are like the bedrock of the economy, providing stability and consistent returns in good times and bad. Procter & Gamble, Coca-Cola, these are the kinds of companies that can weather any storm. They're the anchors of countless portfolios, providing a safe haven for investors seeking shelter from the market's volatility. Chapter 6. The rise of dividend stocks, income and growth in perfect harmony. Now let's talk about a strategy that's near and dear to my heart, dividend investing. With bond yields on the rise, investors are hungry for yield and dividend stocks are serving up a feast. These companies are like the generous uncles of the market, sharing their profits with shareholders in the form of cold, hard cash, utilities, healthcare. These sectors are chock full of dividend aristocrats, companies with a long and storied history of paying out consistent and growing dividends. They're the kind of companies that can help you sleep well at night, knowing that your investments are generating income even when the market is throwing a tantrum. Johnson & Johnson, ExxonMobil, these are the blue chips of the dividend world. Companies with rock-solid balance sheets and the financial firepower to keep those dividends flowing year after year. They're the kind of companies you can pass down to your children and grandchildren, a legacy of financial security. Chapter 7. The retail investor, a force to be reckoned with. Now, let's not forget about the little guy, the retail investor who's been shaking things up in the market. Armed with trading apps and a thirst for quick profits, these individual investors have become a force to be reckoned with. Now remember GameStop, AMC? Those meme stocks may have faded from the headlines, but retail investors are still out there, making their voices heard and their presence felt. They're particularly active in sectors like tech and cryptocurrency, where the potential for outsized returns is like a siren song. Now, I'm all for democratizing finance and empowering individual investors, but let's be real, folks. The market can be a dangerous place, especially for those who don't know what they're doing. It's like swimming with sharks. You need to be smart, you need to be aware, and you need to have a plan. Chapter 8. Market sentiment and volatility riding the roller coaster. Finally, let's talk about market sentiment, that fickle beast that can turn on a dime. One day investors are euphoric, bidding up stocks to nosebleed levels. The next day they're running for the exits, fearing the sky is falling. Fear and greed, these are the two emotions that drive short-term market movements. And right now, with inflation raging, interest rates rising, and geopolitical uncertainty swirling around us, it's no surprise that volatility is rearing its ugly head. But here's the thing about volatility, folks. It's not always a bad thing. In fact, for savvy investors, volatility can create opportunities. It's like a roller coaster ride. You just need to hold on tight and enjoy the ups and downs. The VIX, that fear index we always hear about, is a good gauge of market volatility. When the VIX is elevated, it means investors are nervous, and that can create buying opportunities for those with the courage to buy when others are selling. Navigate the market like a pro. So what does this all mean for investors? The US stock market is currently being shaped by a combination of macroeconomic factors, technological innovation, corporate earnings, and geopolitical risks. While inflation and interest rates are putting pressure on growth stocks, sectors like energy, consumer staples, and dividend-paying stocks are offering opportunities for stable returns. As always, it's important to stay informed and diversify your portfolio to navigate these trends successfully. Thanks for watching, and if you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more updates on the stock market and investment strategies. See you next time.